What is going on, investors? Hopefully, you guys are having a great day out there. Time to talk about Twitter Incorporated. TWTR is the ticker. Now, this company reported earnings last night. We're getting to our stock analysis video the following day. Now, unfortunately, for anybody that's holding Twitter stock, the stock is down 13% during the regular section, but fortunately, if you've held this stock for over the last year, it is up 109% year to date, up 20%. So this has been a very, very strong performing stock. When we get over to the stock chart, we'll talk about that we had created this big gigantic gap in the price chart. We'll talk about what this potentially means, where Twitter can go. Has it rested on a level that makes sense, where it could find some footing and maybe start turning positive as well if you want to go long Twitter stock. We'll obviously jump into the numbers as well. We're going to take a look at the revenue, the profits, the balance sheet. We're going to take a look at it all when we get over to the financials. Now, first thing I want to show you though is let's just take kind of a broad view of online advertising. Okay. Obviously Twitter has its own platform. It has its own kind of niche market. It's big into politics, live events, sports. It's actually big international. It has more people using the site internationally than it does here in the United States, which could hurt it in some cases and could make it different than a Facebook, than a Google, than a Pinterest, than a Snapchat. But here's broadly what I want to talk about. Okay. Twitter is in the online advertising business. Doesn't really matter to online advertisers what goes on the platform, what is being said, who the CEO is. Online advertisers, what they care about is they want to put an ad on the screen. Like down here, you've got these ads. What do they want? They want you to click on it. They want you to sign up. They want you to deposit money. They want your email address. They want you to make a phone call. They want you to buy a product. They want you to do something when you make that click. Okay. And we call that in the online advertising business conversion rate. So sites that have high conversions are going to generate lots of ad dollars because that is exactly what an advertiser wants. Now, here's what I want to show you is during the last quarter, revenue grew by nearly 30%, so not quite 30% over at Twitter. Sounds good, right? On the surface, 30% revenue growth in all cases is typically pretty good, but I want to show you Pinterest. Pinterest, which stock also got plummeted, their revenues grow 78% over the last year. Snapchat, which I think is kind of a niche product, only attracts a certain age group to its platform. Broadly speaking, okay, anybody of any age can use Snapchat, but broadly speaking, the wide majority of users is in a targeted age group, and that is going to get a targeted set of ads using the platform. Well, look, they grew 66%. Now, Facebook, which is the behemoth that had $26 billion of revenue just in the quarter, which is over 20 times what Twitter has done. I mean, this company is gigantic compared to Twitter. Twitter is like an ant on the ground, and Facebook is a monster truck. Okay. They grew 48%. And Alphabet, which is a company that's products are older than some of you that are actually watching this video, their revenues grew 34%, far more mature product there. And Amazon, which they don't break out their online advertising growth, which I think is unfortunate. But I think if they did, it would be accelerating at a very impressive rate, probably better than all these other stocks, in my opinion. But their blended revenue, again, this includes AWS, includes Amazon.com, but I'm just showing you from a perspective here. Their revenues grew 43%. So what is the online advertising business telling you about Twitter, which grew their revenues by 30%, Pinterest 78%, Snapchat 66%, Facebook 48%, and Alphabet 34%? What are they telling you? That Twitter is the worst converting of all the online advertising that they are doing on these social, at least the public companies that are in the social media space. So it's just showing me that Twitter's users don't click on ads as much, don't sign up for things, don't make phone calls, don't order things off the platform. It's just the nature of however either Twitter works or the user that uses Twitter just is not converting at a rate that we see at Facebook, Snapchat, and Pinterest. Because believe me, people do not care what goes on Twitter as long as those users are converting on those ads. It's simply not happening. So that would have me concerned. Number one about Twitter, okay, is that the online advertising business is basically rejecting. Now, what we talked about, though, is look, over the last year, the stock's up 100%. Year to date, up 20%. So maybe none of that matters. Let's go over to the balance sheet and kind of see what's going on here. We got about $9 billion in cash, just under that. That's about where we were in the previous year. The other thing that I notice here is accounts receivable. So accounts receivable with Twitter, I would assume are advertisers that have kind of run some ads and have built up typically how it works in the online advertising space is you run some ads and you pay for them out. You pay for them 30 days later. You know, it's like anything in business. You know, you use the product for a little bit and then you get a bill and then you pay your bill. What I notice is from the beginning of the year, we were sitting at $1 billion and now we're down to 850. Now it could be explained a number of different ways, but that's actually a pretty significant drop in my opinion, just in 3 or 4 months. So what is this showing me? It could potentially just show you that advertisers aren't building up a lot of accounts receivable for Twitter because they'd rather advertise on Facebook or Google or Snapchat or Pinterest. Broadly, that could potentially be happening. Now, total assets 13.4 in the previous period. We've ticked up to about 15. Now, on the liability side, not, like all these tech companies, extremely light on the liability side. Only about $7 billion. They have that in about that in cash. Some of this stuff is like convertible notes and things like that. And so not necessarily a liability that Twitter is going to be responsible for in terms of cash coming out of the balance sheet. Now, revenue. So here's our considered statement of operations. We'll see how they're doing from this perspective, okay? Because everything that I told you might not matter because, look, the stock's up 100%. Maybe people really don't care that the online advertisers are rejecting Twitter in favor of these other platforms. See, revenue here, again, grew in that kind of 30% range, just shy of that, $800 million up to $1 billion. We've got some other costs as well. We get down to our total costs and expenses here, went from $815 to $983. They controlled costs nicely over at Twitter, okay? These costs, yes. Did they grow? Yes. But they controlled them nicely, and they were able to turn an income from operations. Last year, we lost $7.4 million. Now we ticked up to $52 million. I actually like that, okay? Now, we've got some interest expense here, some interest income. Those two almost kind of cancel their self out. We've got our income before taxes sitting here at $50 million. Last year, we lost 15. Now take a look here. Benefit from income taxes. We get an $18 million benefit from income taxes. So all those woke crowd on Twitter that complain about corporations not paying corporate taxes and not paying enough. Well, guess what? The site you're complaining on got an $18 million benefit in the quarter from income taxes. I don't know how that works, but that's how it did. That boosted their net income up to $68 million. Look, I don't really care. You complain about you can say what you want. You can say whatever the heck you want on these sites. I'm just trying to make jokes and make these as fun as possible. Last year, on the net income side, we actually lost $8.4 million. So here's the deal. These are actually pretty nice. And if Twitter can continue to grow, even if it's less than a Snapchat and a Pinterest and even a Facebook or an Alphabet, if they can continue to grow and then keep these costs in check, keep them in line, which they certainly did, look, this is a profitable business, okay? They earned 8 cents diluted. Now, we have to factor in, they made $68 million in a quarter, and this is a company with just a $52 billion market cap. That's given us a PE ratio in the 70s, okay? Facebook, by comparison, is a company with a 25 PE, okay? So you're paying a mid-20s PE on Facebook. Google's got 28 PE ratio, okay? So you have to ask yourself, okay, Google and Facebook are growing faster than Twitter. They're more profitable. They have higher margins. They have more cash. They're executing a buyback. They're doing all this stuff. They're the market leaders. they're trading at a much lower multiple than Twitter. So you have to ask yourself at events, investors have to start asking themselves these questions. And I think that's what investors are doing today with the stock down 13%. They're starting to run all these questions through their head. Like, why am I paying more for Twitter earnings when they're not growing as fast? The balance sheet's not as good. The margins aren't as good. The competitive environment against these other companies is not nearly as good. I think people are starting to ask those questions. Now, moving on to cash flows. Cash flows look good. I think as you'd expect, when you print a nice $68 million, guess what? You get to add back in depreciation, add back in stock-based expenses. That comes down to net cash provided by operating activities at $390 million. Last quarter or last year, we were at 250. So very, very, very solid growth from the cash flow perspective, the net income perspective, the operating side. I think here's the deal. I think if the other companies like Facebook and Alphabet and Snapchat and Pinterest didn't do as well and showed as nice a revenue growth as they did, the stock might not be down as much as it is. But when we get over to the stock chart, it's created this big, gigantic gap here. Okay, so we created a gap back here. The stock gapped up and then filled that gap. If you know anything about technical analysis, you don't have to be a wizard. Believe me, I'm not either. Okay, you could probably watch these videos and understand that. But when you create these gaps, they tend to want to fill in. Do they fill in all the time? No. You look at the Google stock chart and that thing has gaps all over it. Okay, it just keeps going up and up and up. But we filled this gap, okay? We actually filled this gap and rallied off of it, and now we've come back down. Now we've created a gap up here, okay? We've created gaps here as well, and they tend to fill. And so Twitter is actually resting on a very logical spot. Okay, back in December, this stock hung out in this, we'll call it 55 to 56 range for nearly, several weeks, okay, before dropping and then rallying hard. Okay, this thing rallied from the low 40s up to the 80s like in a month or two. Okay, so it's hanging out at a logical spot. Now, if it breaks this spot, be a little concerned. Okay, you definitely would probably shave another $5, $6, $7, $8 off this stock. So it wouldn't necessarily be a spot where I'd be like, oh man, it's down, I'm going to dip by this. Wouldn't necessarily do that, because take a look too. Our trend is down. We made a high here, made a lower high. It's just trending down. This moving average is now kind of got a hump back in it, and it is rolling over. I would wait for this one to create what is, typically kind of a reversal. So typically you'll have a bounce at these levels. Then you'll have typically maybe a kind of a relief selling event, and then you'll have another rally. And so you'll create a formation like this. And what this does is, here's a low, here's a higher low. So that's what you're looking for with Twitter, is maybe a bounce here at 56, back up to 58, a pullback to say 57, and then a resumption over 58. So maybe $58.90, $59, $60. That, in my opinion, would signal somewhat of a reversal, okay? Because take a look at this reversal right here, okay? This stock was on a pretty good downtrend. We made a downtrend here. We had a reversal. Once we got over $48, this was kind of the signal, well, look, you've made now higher lows and we're uptrend. Now, you might say, well, I want to pick this bottom. Well, you didn't have to. You could have came in here and bought this stock at 50 and it rallied all the way up to 80. You could have picked it up here at 60 and rallying up to 80. It's still a great move. So I would be patient with this one. Even if you own Twitter shares or you want it, it's on your shopping list or whatever, I would wait to see what happens here, okay? And then broadly, like what we talked about, okay, you are paying 70 times earnings for a Twitter, and Facebook is at 25 times and Google is at 28 times. And they're growing faster. They are growing faster than a Twitter. Not to mention Google over the last year, the stock's not a chump. It's up 80%. Facebook's up 70%. Now, I know it's not as good as 100% with Twitter, but I would rather be in these names, especially in a portfolio where maybe I had some, I would certainly be overweight Facebook and Google before I was overweight Twitter versus those stocks. So hopefully that makes sense out there. I don't necessarily think it makes a lot of sense to be overweight Twitter, but not have significant positions in Facebook, Alphabet, even Amazon, and potentially even Snapchat and Pinterest as well. Those stocks have also had very, very nice moves over the last year or so as well. So hopefully you guys enjoyed this video. We'll be back again later today with our FANG stock recap show. That should be up around 3 or 4 o'clock Pacific time. And of course, we'll be back again with more videos heading into next week, earnings season in full swing. Hopefully you guys had a great day out there. Good luck with your investments.